Hello everyone and welcome back to these sessions on financial statement analysis for CFA Level 1. In continuation of the topic long-term assets, today we will be learning about impairment of assets. Now, when it comes to impairment of assets, the treatment of impairment under IFRS and under US GAAP, it is little different, and that is why I'll be first explaining to you the whole concept of impairment and how it is measured and recognized in the context of IFRS, and then I will typically bring forward what is the little different treatment under US GAAP. So you will be able to clearly distinguish how impairment is to be understood from IFRS viewpoint as well as US GAAP viewpoint. Now, we will first begin our discussion with impairment of assets under IFRS. I want you people to write this heading, impairment of assets under IFRS. So, once you write this heading, we will then proceed with the meaning of impairment. Quickly write up this heading, impairment of assets under IFRS. Alright, I am sure you must have written this heading, and now what I want you people to do is understand what is the meaning of impairment. The term impairment indicates something that has become weak. Say someone's health got impaired, means someone has become weaker. Losing your strength means impairment. So here it is impairment of assets, means asset is losing its value. So in fact, if you remember, when we have discussed long-term assets, particularly property, plant and equipment in the earlier class, I've given you examples where because of accidents, because of your existing asset becoming obsolete because of new technology, your existing assets value may have a drastic decline, and that decline is basically the impairment. So the term impairment means weakening. So impairment of assets would mean weakening in value of assets. Now, how do we come to know that the assets have got impaired? How do we come to know? So it's all about indications. See, your assets are around you, okay? The moment you find that there is an indication of impairment, you carry out a test of impairment. So when there is an indication of impairment, you carry out a test of impairment, correct? Now, how will you identify whether there is any indication or not? At each balance sheet date or at each reporting date, you have to identify whether there is any indication of impairment. If there is any indication of impairment, you test that particular asset for impairment. For example, while attending my classes, you people would have got experience of the camera closing down in between a few times. Am I right? Yes or no? It happens, right? You have experienced that. Now, for me, because I am owning this asset, for me this is an indication of impairment, that the asset is not working properly. It is an indication of impairment. So you always get indications of impairment because your assets are not functioning well. Suppose you are driving your car and your car is not able to give you that good speed, and now you are finding that it's like very old car and now it needs a replacement, and maybe its value has got impaired or it is heavily depreciated. Say unfortunate events like accidents occur and your assets get damaged, it is an indication of impairment. So at each reporting date, the entity has to observe whether there are any indications of impairment. if you find any indications of impairment with respect to any asset, you place that asset for test of impairment. Now, test of impairment is a process where you first find the carrying amount of the asset, then you find the recoverable amount of the asset. So, we will learn what is carrying amount. Carrying amount is basically the book value. The amount at which you carry the asset in your balance sheet is your carrying amount of the asset, correct? The book value of the asset basically. So, book value of the asset is the carrying amount. What is recoverable amount? The term says recoverable amount, amount that you can recover. Now, basically amount that you can recover the amount of any asset either by sale of that asset or by using the asset, correct? So, the value that you derive by using the asset is called value in use, correct? Value that you derive by using the asset is called value in use, and value that you derive by selling the asset will be the net selling price. Net selling price is basically the fair value of the asset minus the cost of disposal. Fair value of the asset, say if I want to sell any asset, what is its fair value? Because I will be selling the asset at its fair value, but there may be some cost, some kind of legal expenses, brokerage, etc. that I might have to incur to sell the asset. That cost should be subtracted to give me the net selling price, correct? So, the fair value less cost of disposal is one value which we can recover, and when we use an asset over a period of time, it will generate future cash flows. Every asset has capacity of generating future cash flows. So, future cash flows obtained from any asset will be obtained in future. You find the present value of those cash flows, the lump sum present value of all cash flows that arises from the usage of the asset, including the present value of the scrap value that you get from the use of the asset, from sale of the asset on its termination basically. I repeat, you have to identify the present value of all the cash flows that arise from use of the asset during its life, and the present value of the terminal cash flow which arises as a scrap value on termination of the asset, the present value of that cash flow also to be considered. All these aggregate present values will give you the value in use. So, now you have two amounts which can give you hint of recoverable amount. One is the fair value less cost of disposal, another is the value in use. Now, you have to pick one of these two values as a recoverable amount. Logically, if you are owner of the asset and I say if you sell the asset today, you would get 80,000 US dollars. If you use the asset today, the present value of all the future cash flows will be 90,000 US dollars. Now, as owner of the asset, what would you prefer? Receiving $80,000 or receiving $90,000? The obvious answer is receiving $90,000. You would want to receive more. That is why the recoverable amount is the higher of the two values. Higher of which two values? The fair value less cost of disposal and the value in use of the asset. You compare, whichever is higher you pick it as recoverable amount. That recoverable amount which you have picked up as the best value out of the two, if that is lower than the carrying amount, means the asset is carried over at still a higher amount, that means the asset is overstated in your balance sheet. You need to bring down the value of that asset. That bringing down the value of the asset is called impairment. So, impairment loss is recognized by taking the difference between the carrying amount minus the recoverable amount. So, if the recoverable amount is less and carrying amount is more, the asset is impaired. If the recoverable amount is more or equal to the carrying amount, the asset is not impaired. So, you got indication of impairment, you carry out a test of impairment, and while you carry out test of impairment, it is possible that you come to know that okay, even though the asset has given indications of impairment, but the asset is not impaired, the asset can function well. So the outcome of test of impairment could be both. Either the asset is impaired, then you measure and recognize the impairment loss. If there is no impairment, just leave it. So what I am going to do is, I am going to give you these all pointers as important notes, and I would want you to write down these all notes systematically. So we begin with the meaning of impairment, which is weakening in value of assets. An asset is impaired when its carrying amount exceeds its recoverable amount. What is carrying amount? Carrying amount is the amount at which the asset is recognized after deducting any accumulated depreciation or amortization and accumulated impairment losses thereon. What is recoverable amount? It is the higher of the following: fair value less cost of disposal and value in use. Whichever is higher out of these two will be considered as recoverable amount. Then the book value of the asset is its carrying amount, and when the asset's carrying amount exceeds its recoverable amount, so carrying amount being greater than recoverable amount, it is indication of impairment, or rather you can say that the asset is actually impaired. So you can mention this either way. You say carrying amount greater than recoverable amount, or you can say recoverable amount less than carrying amount. Both way we conclude that the asset is impaired. Let us move ahead and continue writing further. What is value in use? I have already explained to you. It is the present value of future cash flows expected to be derived from the asset or cash generating unit. What is impairment loss? If the recoverable amount of an asset is less than its carrying amount, the carrying amount of the asset should be reduced to its recoverable amount. That reduction is an impairment loss. So impairment loss equals to carrying amount minus recoverable amount. If the recoverable amount is more than or equal to the carrying amount, no impairment loss is accounted for and the asset is not impaired. Let us move ahead and continue writing further. Indications of impairment. Now I have already explained to you indications of impairment. You just need to write it down. So under the heading indications of impairment, you please write: an entity shall assess at end of each reporting period whether there is any indication that an asset may be impaired. If any such indication exists, the entity shall estimate the recoverable amount of the asset. Now one point which is very important, which I haven't explained to you yet, is coming now. Irrespective of whether there is any indication of impairment, an entity shall also test for impairment annually an intangible asset with an infinite or indefinite useful life, or an intangible asset not yet available for use. An entity shall also test goodwill acquired in a business combination or impairment annually. Now before you start writing this whole thing, this later part which you are finding over here, I am going to give you elaborate discussion on this when we are dealing with the next part of this topic, long-term assets, that will be intangible assets. I have covered the major discussion of this part over there, because over there I will be able to logically explain to you why it is this way. But as of now you understand one thing: three types of assets which are all intangible assets should be tested for impairment annually, whether there is any indication of impairment or not. What are those three types of assets? One is intangible asset with an infinite or indefinite life. Another is intangible asset which is not yet brought to use, means you have acquired the intangible asset, you haven't started using it yet. And third is the goodwill arising on business combination. If there is any business combination and goodwill arises over there, goodwill is also a type of intangible asset, and it will be tested for impairment annually, whether there is any indication or not. So at each balance sheet date or at each reporting date, you must test those three types of intangible assets necessarily. I'm not asking you to test all the intangible assets, but these 3 types of intangible assets only. In fact, as I said, the elaborate discussion about this point I'll be covering in the next upcoming topic, that will be the intangible assets. As of now, you quickly write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue further. An important note: if there is an indication of impairment, the depreciation or amortization method or the residual value for the asset needs to be reviewed and adjusted in accordance with the standard applicable to the asset, even if no impairment loss is recognized for the asset. Now, before you write this important note, let me provide explanation to this. Suppose there is an item of property, plant and equipment which has been depreciated regularly over the past 2 years. So now, as per your original estimate, the life of the asset was 10 years. Life of the asset was 10 years, 2 years have passed by, so remaining life would be 8 years. Now, this particular asset, it started giving indications of impairment. That means at the second year end, there were indications of impairment with this item of property, plant and equipment. So what you did, you tested this asset for impairment. Then when you are estimating the future cash flows that can be generated out of the use of the asset, you could identify that the asset will now remain with you for usage only for the next 5 years. So originally 10 years of total life, which was considered as estimated useful life, of which 2 years have passed, so 8 years life should remain, but now your revised estimate, because of the impairment test, it is only 5 years. But the outcome of impairment test was what? That the asset is not impaired, its carrying amount is less, its recoverable amount is still more. So there was no impairment loss, but we got one new update in the information, that the remaining life of the asset is not going to be 8 years, it is going to be 5 years only. As a result, your depreciation method or the depreciation amount may undergo a change, correct? Because this is having a change in the relevant standard, that is what we have learned under property, plant and equipment, you must make the adjustment of the carrying amount even though there is no impairment loss with respect to the revised amount of depreciation that may arise because of the changes in the estimate of the useful life of the asset. So the effect may be prospective. So what you have done by far, you don't have to change. Later stage, you have to then make adjustment of depreciation based on your revised estimates that you have obtained during the test of impairment. So in a nutshell, if there is any asset for which you had indication of impairment, you tested that asset for impairment, any possibility may arise, either the asset is impaired or not impaired, but under either circumstances, if the change is suggested with respect to the remaining useful life, that must be considered, and the prospective year's depreciation should be computed accordingly. This is a very, very important note. I want you to write this carefully. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. Recognition and measurement of impairment loss. I want you all to write this heading, recognition and measurement of impairment loss. Once you write this heading, recognition and measurement of impairment loss, under that heading, you further write, if and only if the recoverable amount of an asset is less than its carrying amount, the carrying amount of the asset shall be reduced to its recoverable amount. That reduction is an impairment loss. An impairment loss shall be recognized immediately in income statement unless the asset is carried at revalued amount in accordance with another standard. Any impairment loss of a revalued asset shall be treated as a revaluation decrease in accordance with that other standard. Let me first explain this to you before you start writing this stuff. See, while learning the revaluation model under property, plant and equipment, try to recollect, we have understood the process of revaluation. Let me give you a recollection of that. We have learned one thing, that if there is any revaluation which is upward, you will not recognize that as a gain in your income statement. You are going to recognize that as a revaluation surplus, and it will be considered as a component of equity, that is a component of shareholders' funds under the head revaluation reserve, which will be recognized through not the income statement but the statement of other comprehensive income. So it will be stated in the balance sheet as a reserve, revaluation reserve. When there is a subsequent downward revaluation, to the extent of the available revaluation reserve, you will not charge that downward revaluation in the statement of P&L or in the income statement. You will be charging that downward revaluation against this revaluation reserve. Isn't it? This is what we have learned with the revaluation of assets under property, plant and equipment. Now you understand one thing. What happens when there is an impairment loss? How will you recognize impairment loss? So when I say impairment loss equals to carrying amount minus recoverable amount, we are measuring impairment loss. Now when we talk about the recognition, how will you recognize? Impairment loss will be recognized as a loss in the income statement, straightforward. But if it is an impairment loss arising on a revalued asset, means an asset was revalued upward earlier and the revaluation reserve exists for that asset, then the impairment loss should first be charged to that revaluation reserve. Excess impairment loss, if any, should be charged as a loss and will be recognized as a loss in the income statement. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue writing further. When the amount estimated for an impairment loss is greater than the carrying amount of the asset to which it relates, an entity shall recognize a liability if and only if that is required by another standard. After the recognition of an impairment loss, the depreciation or amortization charge for the asset shall be adjusted for future periods to allocate the asset's revised carrying amount less its residual value, if any, on a systematic basis over the remaining useful life. So out of these two paragraphs that I have displayed on screen, second paragraph does not require any specific explanation, and the paragraph on top, I would say it is not that much relevant for you. While I was drafting these notes, I could not miss out that discussion from IFRS. I am going to explain you this, but in your exam this may not be that relevant. But still listen to me. Imagine that you have an item of asset which has a carrying amount of $10,000. When you try to find the recoverable amount, say the asset does not have any recovery possible, the recoverable amount is 0. In that case, your impairment loss will be carrying amount minus recoverable amount. So carrying amount is $10,000, recoverable amount is 0, impairment loss is $10,000. Means the entire carrying amount is appearing as a impairment loss. So when you charge that impairment loss, the value of that asset automatically becomes 0. So 10,000 was the carrying amount. 10,000 of impairment loss you charge, recoverable amount or the revised carrying amount becomes 0. That is not a problem yet. The problem will arise when that revised carrying amount after charging impairment loss is getting negative. Imagine a possibility that the impairment loss is greater than the carrying amount. Let me explain that to you. In that same example where your assets carrying amount was $10,000, nothing could be recovered from that asset, that is defined. But to dispose that asset, you will have to spend $2,000. That means there is no recoverable amount, but there will be spending from your pocket. So fair value less cost of disposal. Fair value was 0. Cost of disposal is 2000. And when you take fair value less cost of disposal, it is giving you negative 2000, minus 2000. Now what will happen? You try to compute impairment loss. Impairment loss is carrying amount minus recoverable amount. Carrying amount is $10,000. Recoverable amount is negative $2,000. So 10,000 minus negative 2,000 will give you impairment loss as $12,000. Now charge impairment loss on that asset. Carrying amount is 10,000. You need to reduce that by 12,000. The asset's value will become negative. So when the asset's value is becoming negative, it is a liability. That liability should be stated, and logically it is a liability because you will have to dispose this asset. You will get nothing, but you will have to spend $2,000 to dispose that asset. Isn't it a liability upon you instead of an asset? When impairment loss is greater than the asset's carrying amount, your net book value after charging that impairment loss will become negative, and the asset will not be stated as an asset in the balance sheet but will be stated as a liability. So please carefully take note of these points and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue further. Impairment of assets under US GAAP. Now we have been learning impairment of asset under IFRS. Now we start with the discussion on impairment of assets under US GAAP. Now this is going to be easy. Under US GAAP, impairment of an asset occurs when the carrying amount, that is the book value of an asset, exceeds its recoverable amount. So this line precisely no difference at all. Where the difference is coming, I am showing you. The recoverable amount is determined based on the sum of undiscounted future cash flows expected to result from the use and eventual disposition of the asset. Now look at this big difference. Under the US GAAP, how will you identify whether the asset is impaired or not? You have to compare the carrying amount and recoverable amount. Now recoverable amount under IFRS was higher of the two values. Which two values? Value in use and fair value less cost of disposal. But under US GAAP, there is only one meaning of recoverable amount. It is the estimate of the future cash flows, but not converting those into present values. Undiscounted cash flows in future, including the residual value of that asset, all those cash flows summed up will become the recoverable amount. If that recoverable amount is less than the carrying amount, then and then only the asset is considered to be impaired. Are we clear on that? That here under US GAAP, the definition of recoverable amount is completely different. Where there is a difference, you need to take extreme degree of precaution. Otherwise, mostly you will be finding same requirements under the two. So, under US GAAP, an asset is considered impaired when the carrying amount exceeds the sum of undiscounted future cash flows expected from the use and eventual disposition of the asset. Once it is determined that the asset is impaired, the impairment loss is measured. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue writing further. The impairment loss is measured as the amount by which the carrying amount exceeds the asset's fair value. The loss is the excess of carrying amount over the fair value. Impairment loss equals to carrying amount less fair value. Now just understand one thing over here. The approach of computing recoverable amount is different under US GAAP. Even the impairment loss measurement is different. Here you cannot write carrying amount minus recoverable amount. It will be wrong because recoverable amount was sum total of the undiscounted cash flows. Correct? here you have to bring down the assets carrying amount to its fair value. Just in case if the fair value is not determinable, then you have to consider all the future cash flows, but because it is value as on today, you have to bring all the future cash flows to their present value, and the present value of future cash flow will be assumed as the fair value. So keep in mind one thing, the first stage is to identify whether the asset is impaired or not, and whether the asset is impaired or not once you assess, then you have to charge the impairment loss. Impairment loss over here is not carrying amount minus recoverable amount, it is carrying amount minus fair value. What if fair value cannot be determined? Then the future cash flows that you can estimate from the use of the asset, including the scrap value or the residual value of the asset, you have to discount it to its present value. Now present value calculations will come into picture for computation of impairment loss. So to identify whether the asset is impaired or not, the future cash flows should not be discounted, but to measure impairment loss where fair value is not determinable, you want to use the cash flow estimates, then cash flows should be converted to their present value for determining the estimate of the fair value where the market value is not determinable. So let me give you that point also as an important note over here. When fair value cannot be determined directly from market prices, entities often rely on the discounted cash flow analysis. This method involves estimating the future cash flows expected to be derived from the asset and discounting them into their present value using an appropriate discounting rate. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue further. Reversal of impairment loss under IFRS. Now, as a matter of fact, it is only IFRS that allows reversal of impairment loss. If I write the heading, reversal of impairment loss under US GAAP, I will just write one extra word, that is prohibited. US GAAP prohibits the reversal of impairment loss for any kind of asset, but IFRS prohibits the reversal of impairment loss only for goodwill. For goodwill, impairment loss cannot be reversed, but for all other assets, impairment loss can be reversed. Now, how will you go for reversal of impairment loss? Obviously, when I say reversal of impairment loss, it is increasing in the value, right? So, how did you charge impairment loss precisely? When you got indication that the recoverable amount of the asset is less, you tested the asset for impairment. When you get reversal indications that the recoverable amount of the asset has exceeded the carrying amount, then you go for test of reversal of impairment loss. Now, obviously, this test of reversal can be performed only for assets that have impaired in the past. If there was no impairment in the past, we cannot say reversal of impairment. Suppose there is no impairment of asset in the past, in spite of that you are trying to increase the value of the asset, you can do that, but then it is revaluation of the asset, then it is not reversal of impairment. Reversal of impairment necessarily means when you have made a impairment loss on an asset in the past, now you are getting indication that the recoverable amount is greater. So what you now do is, you find the recoverable amount, and if the recoverable amount is found to be greater than the carrying amount, you increase the carrying amount to the extent of recoverable amount, and that increase will be treated as reversal of impairment loss. Fundamental logic is reversal of impairment loss should never exceed the amount of impairment loss itself. Suppose $8,000 was the amount of impairment loss, your reversal amount could be maximum $8,000. It can be less than that, it can never exceed $8,000, because reversal of impairment loss cannot exceed the amount of impairment loss itself. But all this discussion is relevant under IFRS. Under US GAAP, reversal of impairment loss is prohibited. Let us write up some notes in this regard. Under the heading reversal of impairment loss, that will be under IFRS, you please write, an entity shall assess at the end of each reporting period whether there is any indication that an impairment loss recognized in prior periods for an asset other than goodwill may no longer exist or may have decreased. If any such indication exists, the entity shall estimate the recoverable amount of that asset. An impairment loss recognized in prior periods for an asset other than goodwill shall be reversed if and only if there has been a change in the estimates used to determine the asset's recoverable amount since the last impairment loss was recognized. So please write up this whole thing and keep in mind one thing, that even under IFRS, other than goodwill has been mentioned a few times. That means whenever you find other than goodwill, it is a clear indication that reversing an impairment loss for all asset is possible other than goodwill. For goodwill, even IFRS prohibit the reversal of impairment loss. So please write up this whole thing, and then I give you just one line closure regarding reversal of impairment loss under US GAAP. Alright friends, once you have completed writing this whole thing, let us move ahead and continue further. Just write one closing line, that reversal of impairment loss prohibited under US GAAP. Just this closing line, and that will be end of this particular topic.